Hello, Hans.
Hi, Björn.
Now the world keeps on turning, and in recent weeks we've seen multiple events that could have an impact on both the economy and the stock markets. Let's take a closer look today, and maybe we can start in France with the political situation there. Prime Minister Sébastien Lecornu has offered his resignation to President Macron. Now, how big is the impact of that on the economy and on the financial markets?
Not a whole lot, we believe, in the sense that the situation is known for a long time already. The budgetary situation also looks really difficult, but that's something markets know for a very long time already. So what is happening is today that we don't have a clear signal from the government, an engagement to really step up budgetary efforts. But on the economic side, we don't think there will be much of an impact because largely, the private sector still sits on quite a lot of money. There's a surplus in the private economy in contrast to the government. And if we combine that with a limited risk of contagion, and so the ECB keeps on repeating that it stands ready to intervene, I think the overall impact should be contained. And that's the reason why, we can't ignore the situation is there, are still largely holding on to corporate credit rather than government debt in Europe.
Now, look at the other side of the ocean, United States, where the government is in shutdown due to the fact that Republicans and Democrats have failed to reach an agreement on government spending in Congress. Now, about 750,000 officials are at home, on leave without pay. What does this mean for the American economy? What do we know from the past?
If the past is any guide here, the impact will be relatively contained. So we're talking about a couple of tens of basis points of GDP. That's not much, and most of that loss is recouped in the months after the government opens. But what's interesting here is that Mr. Trump could seize this moment to fire even more federal employees, and that could weigh extra on the labor market, which is already slowing down significantly. So this is actually referring to something interesting. On the one hand, we see the labor market really being frozen, so to speak, and so it's a very low hiring, low firing labor market. But on the other hand, we still see consumption holding up, and we also see some companies doing massive investments in data centers and also software. So the whole AI narrative, if you want, is shaping up, and that is also propping up US economic growth. Most likely this will continue for a while yet, and that's also we keep an overweight in US equities.
You referred to AI. What we are seeing today is massive investment in AI tools, in scale-ups, and on the other hand, AI-related stocks that are performing very well. Are we on the verge of a bubble?
It's a trillion-dollar question, really, because that's really how much money there is involved. The least we can say is that there's a lot of hype. There are also pockets of exuberance. So the word exuberance refers to what Alan Greenspan already said in the 90s, in the 1990s, in 1996, when he used the word irrational exuberance. But it was only years later that the bubble actually bursted. And so timing this is really difficult. And so the big question will be for companies to integrate the whole AI tools into their day-to-day business operations. And I think it's fair to say that a lot of these investments that are currently being done, that not all of them will bear fruit, not all of them will be productive. So in that sense, I think the situation deserves clear monitoring, yes.
So we are in a phase of euphoria. What if this turns into pessimism? Is this a big chance?
There's a chance. There's even a good chance if we look at history. If we're talking about really revolutionary technology, then history says that at some point in time, the euphoria will give way to pessimism. And so the question is, why would it be different this time? But when it comes to the economic impact, what really is at stake is how much debt there is involved. And for now, the situation remains largely manageable. It's mostly equity-driven, this whole AI narrative, but this is something we need to watch closely. And also, I think at this point in time, this is where our analysts can really help us in really making that selection, which AI companies are still earning their money, which revenue streams are sustainable. And that, I think, is really important. That's also the reason why we remain very much diversified within the whole portfolio.
Hans Bevers, thank you very much for bringing us up to date.
You're welcome.